Hello everybody. Welcome to it's going to be a question and answer session. We're not going to try to pitch you anything, just want you to know a little bit more about our trading group. And let's go ahead and get started. And if you guys have any questions as we go along, just speak up. We have a small group, so hopefully you guys will have a lot of good questions. So today I just wanted to introduce myself. I want to talk about the strategies we use, talk a little bit about the community features, and primarily want to answer any questions you have. So with that, my name is Brian Terry, and I formed the Conservative Covered Call Facebook group, and I also formed the Conservative Options Trading Groups, which is a private trading community. So my background, I'm a certified financial planner. I retired after a career as a fee-only financial planner, and I've been trading options pretty consistently for about 10 years now. And we started this Conservative Covered Call Facebook group. We have over 2,400 members in it, and about 3 years ago, I started a private trading community, mainly people who know me in the Central Florida area and some other friends. So we started small. We just kind of wanted to set up a system where we could talk to each other, trade ideas, and go from there. So my initial strategy was an in-the-money covered call, which is a really different strategy. It's ultra conservative, and it's an income strategy where we actually buy the stock, sell an in-the-money covered call, which gives us income as well as downside protection. Since then, we've added a few other strategies. Some of the members in the group have come up with other ideas. So we continue to add strategies based on what the group wants to do. And we built a website that really kind of covers all of the aspects of our trading community. So the main strategies that we do now, we do an in-the-money covered call, which was our primary go-to strategy, and we still do a ton of those. And we've started to do some at-the-money calls, covered calls. We do a strategy called the dividend capture strategy, where our focus is to buy the stock, sell a call slightly in the money, and so that we get the dividend. So we get the premium from the selling the call, we get the dividend, and we still have that downside protection. We do a trade that we invented in the group. I just call it the bond substitute trade. And this is a trade where we pick, really high level, high dividend paying stocks. We buy the stock and we sell calls like 6 months out, so that we can get the dividends, 2 dividends, and have somewhere between 20 and 30% of downside protection. And then we do a strategy, not as often anymore, but the dividend scalp. And what that is we will buy the stock, sell the call, and we get a credit, a premium for selling that call. And if we don't get the dividend, they will exercise us within a day or two, and we make a nice return in a really short period of time. So those are kind of the different types of covered calls that we do. So the biggest one is either the in-the-money covered call, or the dividend capture. So those are the big ones we do all the time. We also do diagonal call spreads, which I like to call a leveraged covered call, where we buy a call, say, 4 to 6 months out, and we sell calls against it. And then we do put spreads and cash secured puts, kind of like the wheel strategy. So those are the primary strategies that we do in the group. So any questions so far? Anybody have any? Everybody good? Okay, so here's just a copy of what our alerts look like that we send out to all of our members. This is a dividend capture trade that we did a few days ago. It was in Starbucks, so we'll say, you know, what the price is, what the credit is, and what the return and the downside protection is. So those are, and so that's just an example of a dividend capture trade. Here's a cash secured put, a put spread in Lockheed Martin. We took the trade, we were able to close it in about a week. This is our diagonal call trade. We did it in XLI, and we went out and sold a June, or bought the June 120 call, 130 days out, sold the 217. So that's and the goal there is if the stock moves up to our call strike, we'll probably get out of the trade, and our goal is 30 to 50% return on our net debit. Here's a dividend capture trade where we actually buy the stock, sell the in the money covered call, and collect the dividend. So that's one of our favorite strategies in the community. Let's see, here's a bond substitute trade where we actually buy a stock, sell out. In this case, we sold a May option. We were able to collect 2 dividends. And so it was like an 11% annualized rate of return with 31% of downside protection. So I kind of equate it to it's more conservative than even our than our in the money calls, and it's kind of was built to kind of substitute for a bond purchase. And let's see, here's a copy of our watch list. It just has all the stocks that we have, and I send this to all the members every Sunday. It shows, the price, what the call would be, what the cash secured put credit would be, and what the put spread would be if we just wanted to do a straight put spread. So, and then one of the other things that we do is a market scorecard where we just kind of analyze the overall market based on a number of different metrics like RSI, what's the VIX, is the market above the 50-day moving average, what's the McClellan oscillator, the new high, new low. So it gives us a good idea of kind of where the market stands. We also talk about earnings, economic events, and then other facts that I thought maybe were interesting. So that is the overall real quick. So mainly I wanted to open this up to anybody who has a question, either on the slides or just about our strategy. Anybody want, and you can type it in the chat room, in the chat if you like. Okay, so one of the questions that we got, and I'm going to stop the share so I can share with you a couple of things. One of the questions is, how do we determine our rate of return? So I'm going to go back and open up and share with you our watch list. So here's the live watch list, and you can see it has all kinds of things, but one of the categories here is rate of return. So what we calculate is what is our net credit divided by the cost, per 100 shares. That's our rate of return. And then we take how long we're going to be in the trade and calculate an annualized rate of return. And we also calculate the downside protection. So that is the downside protection is basically how far the stock can drop in price before the trade loses money. So ideally, we like to get about a 5% of downside protection on all of our trades. So we look at, what's the rate of return, what's the annualized rate of return, and what's our downside protection. We talk about those all the time. So those are 2 of the questions. And anybody in the group have another question?
Jim has one, Brian. How
Okay.
are you managing overall markets risk?
How do we assess the overall market risk? Great question. We like to look at the market scorecard is probably one of our gauges. We're looking at, is the market in a bullish or bearish or neutral position right now? We use IBD. We use a measure called the CNN Fear and Greed Index, which is an interesting measure. It measures about 7 different criterias of market strength. And as of Monday, it was at an extreme greed or very overbought. So that's kind of mainly how we look at the overall market. We look at the charts. We look at the McClellan oscillator. We keep track of the 10-year Treasury rate of return, what's the dollar doing, and what is the yield curve. So we want to focus on those kinds of measures. And also we look at the put call ratio. One of the things that I do as well is I highlight what sectors are doing the best and which are doing the worst. That helps us to kind of say, we need to focus in on the sectors that are doing really well and avoid the ones that are doing poorly.
Yeah, and Brian, just a follow-up question from Jim, and then we can go for Adam. I don't know if you can read it on the chat.
I can. Yeah, I can see it. So, can you tell about a trade that was way underwater? Not sure where you go from here. So that's a great question. And so one of the things, let me go back to our score.
And Brian, I think Adam, he wants to know, he told you he sold Amazon 120 put. So he's giving you the exact trade. He's underwater.
Oh, okay. So let me get that. So you sold Amazon 120 puts. Let me see if I can find let me bring that up on my chart here. So you have 100, so you have the 120 puts I received. So yeah, I mean, one of the things that we do first is we try to look for we do a screening process based on fundamentals and technicals. And one of the things that we do in our group is really focus on stocks or ETFs that have a low beta. So Amazon is a pretty high beta stock. It's a big mover. So what is your expiration, Adam? You can type that in. So you sold
yeah, and in the meantime, you can explain what a high beta stock means.
Sure. So a high beta, it says it expired last Friday. So it looks like you would have probably been assigned the shares if it expired last Friday. But a high beta stock is when you look, okay, so you got the shares at 8, you got the shares assigned to you at 120. So your basis would be 110 just based on the fact that you got $10 per contract. So what I would be doing is selling calls against it to to try to recoup and get out of that position. So that's a tough position. So but if you think you're still bullish in the stock, I would start to sell calls against it where not too close to the money. Don't try to get the whole $10 back immediately. Sell a call that's, say, a 10 delta or 15 delta. So if the stock goes up that far, you're going to do really well and not get taken out early. So that's the biggest fear when you get underwater in a wheel strategy. I hope that helped. But let's see. One of the things that I built into our watch list is when we put a trade on, we set what the exit level is. And this is set at 8% of whatever the stock price is. So when we buy the stock, we know immediately what our exit level is. So we don't stick around on stocks that move below our exit level. So we use that as a guide, and it helps us stay out of trouble. And when we're selling, cash secured puts or put spreads, we're trying to go as far out of the money where we get a great rate of return, but not, so if it drops that low, we're getting it at a really good price. And I know, Adam, you probably felt like that was a really good price, but we're selling somewhere in the 15 to 20 delta for our short put. So that's how we do it. And then we'll take the shares as long as it didn't drop below the exit level, and sell calls against it. And then on the watch list here, I will include like the dividend, like this was XOM. I'll list what the dividend is. And then, so here's the rate of return. Here's the downside protection. And it will tell you here what the dividend amount is and when it goes ex-dividend. So we really focus on, getting the stock shortly before the ex-dividend date, selling a slightly in the money covered call, and making a really nice rate of return. This one would be 35% annualized, or 3.6 in just over a month. So that's kind of the strategy there. Let's see here. Okay, so the question is, well, how do you manage a trade when one sells a call and then the stock shoots up 15%? So that's a tough kind of situation, especially if you really want to hold on to the shares. So for people who own shares, and in most cases they have long-term gains kind of built into those shares, so they don't want them to go away, we recommend selling deltas, the 10 to 15 delta, or just beyond the expected move or resistance level. If you're in a covered call and the stock shoots up 15%, there's a couple of things you can do. You can roll the call out and continue to collect additional credit by doing that, or you can close the call if you just don't want to have your stock assigned early. There's not much else you can do, but if you're in the money and you roll it out, sometimes you can roll it out and up so that your assignment level is higher, then you're going to improve your current position. But if you roll it out, give yourself more time, maybe the stock pulls back a little bit, and then you're in good shape. So I hope that helped, Bruce. That's a tough one, and that's kind of the downside of selling covered calls. You have the stock, you sold a call to get additional credit, and now it blew through your short call. And if you want to hold the shares, then you got to do something. You got to either roll out the call or close the call and take the loss on selling the calls there. So that is, I hope that answered your question, Bruce. Okay.
And Brian,
Yeah.
I think Jim had a follow-up questions on the downside section if you scroll up. And Jim, also what I'm going to do, and for everybody, I'm going to put on this chat the formulas we use on our watch list, so you can see it and you can download the PDF. But Brian, if you can, further explain a little bit more on the downside protection for Jim.
Yeah, so great question. So on our put spreads, when we sell a cash secured put or a put spread, we're not getting out at 2 times or 3 times. What we're saying is we're willing to take the shares at that price. So we will hold it unless it moves through, 8% below that short strike. So unless it goes that far down, we will take the shares and sell calls against it. So it's not like a regular just credit spread where we're selling calls. And we're selling credit spreads and getting out if the credit expands. This is more like the wheel strategy, where we're taking the shares if they drop. And on the watch list here, we set up a special column here for what the put spreads or the cash secured puts are here, the put spreads are over here, and what I do is I will try to go as far out of the money as I can. So if they're highlighted, the put spread is actually lower than the short call. So that's one of the things that we try to look at, because we're looking for income, but we're not, but we're willing to take the shares. So hope that answered that question. Okay. Someone asked, how do we find our stocks? So a couple of things. One is I look through the ex-dividend calendar as it's coming up, and I will write down all the stocks that are coming up in the next 2 weeks for dividends. And then we run them through a screening process where we're looking at fundamentals and technical strength. So they have to pass both of those before we even run the numbers. So that's one of the sources. The other source is we use IBD. We look at their big 20 list, the more of the blue chip. We also look at upcoming earnings because we do a lot of after earnings trades. And then we also focus on what sectors are doing the best. So we'll look at the sector, we'll drill down to the stocks within that sector, and then add those to our watch list. So that's how we find our stocks. And then the watch list is a community watch list. So if somebody has another idea, we have space on the watch list for people to enter their own trades and share it with other members. I also created a list of high beta, meaning over 1.3. So they were good stocks. Their beta was just too high. So we created a watch list, same criteria. It's just we separate high beta and then everyone else. This is what I like to just say, it's kind of a workshop. People can, you can enter your stuff in here. You can, use the formulas. And speaking of formulas, the spreadsheet once you've entered in the price, the short strike, the credit, the dividend, and the expiration, everything else is calculated for you. The cost per shares, the return, the downside, everything is calculated. So you don't have to worry about, figuring that out. It's already there. So that I hope that helped. That's it's a great source for trade ideas, and you can see it'll include both ETFs and stocks. So and this one had 30 stocks on, and they're arranged by the annualized rate of return. That's how we sort them. But any other questions that anyone has? I hope this has been helpful. We started the Facebook group a number of years ago, and it's been great. We've had a lot of people in it, but a lot of people also wanted to find, a smaller community without all the noise. So that's why we started the group. And I wanted to kind of take a few minutes today just to kind of share with you our platform and all that kind of stuff. And then also, answer any questions that you have. So.
And Brian, I think one of the questions we also had before starting the session was, why is sometimes better selling a put spread versus an in-the-money covered call for the defined risk?
Yeah, I mean, one is, you get a higher rate of return by selling either a cash, especially a put spread versus an in the money. It's a capital thing. So sometimes what we'll do is we'll sell a put spread or a cash secured put so that we can get the shares so we can collect the dividend. But a lot of people, we sell a lot of put spreads because they generate a really nice rate of return, somewhere in the 5 to 10% return on risk. And if we get the shares, we're getting them at a significant discount of the current price. So that is the reason we do that. And we list them, the put spreads, the cash secured put, and then the in the money covered call. And sometimes we'll list the in the money and the at the money kind of next to each other so that you can compare. So that's kind of why we do that. In terms of what we do in the watch list, in our trading community, I send out a weekly watch list. Goes to everybody on Sunday morning. Anytime I make a trade in the community, I send a trade alert, and you saw a couple examples of those, and we put them if we make any adjustments or we close them. So those go out all the time. We do the market scorecard that's talked about in our Monday pre-market thing. Every morning I send a daily summary email of everything we did the day before, as well as a little bit of market commentary. We do a Wednesday training session. Every Wednesday, we either do a training session or we look for a live trade together. And Friday at 2 o'clock, we do a market wrap-up call. It's a webinar, and it's a great way to kind of say, okay, where are we at with all of our positions, and answer any questions. We have a chat room. We have email support. So it's a pretty comprehensive group. It's kind of built to kind of help the trading community kind of function and stay in touch with each other. So, and Antonio, he helps me with all of the administration stuff, the website, all of the technical things. So he's a great help and a great asset to our community. So thanks for jumping on the call, Antonio.
You're welcome.
Before I go, any final questions or feedback on
and positions? And if you guys like some other questions, like Adam, if you guys have any positions that you guys want to ask Brian, I think this is a great time to do it. So he can review it for you, or whatever you want to ask. I think this is a great time to do it. This is the purpose of this session as well.
So Jim had a great question. He says, why are you going out 3 months versus going out 6 months or more for the leap strategy? So, it's actually not a leap, it's a diagonal call. So what we're trying to do is go out, 4 to 6 months, and so that when we see a stock or an ETF in a bullish trend with a clear kind of target, we're trying to basically, instead of buying the shares and selling the call, we're buying a call and selling weekly calls against it. So it's not really your traditional leap. We found this strategy to be really do really well. It's I think we've probably since we started about a month ago, we've closed 10 trades, 9 of them for winners. And what we shoot for on these is like a 30% return of our net debit in the trade. So you can go out further. We just tend to want to, get in the trade, sell it for, 3 to 4 months, and close it when we can make a 30% return. So that's our strategy of how we do the diagonals. So Adam asked, what's our opinion on a 45-day strangle? I'm selling 45-day 7. I think that's great. That's a very conservative strategy. It helps, it's far enough out of the money, and it's pretty. And are you closing them based on a time stop too, Adam, or are you just going when I hit 50%? So a lot of people do it differently. So, okay, so you're close. That's a very, good way to do it. It's very mechanical. You're selling the 7 delta strangles, really just an iron condor without the legs. You're exiting at 50 days or 2 times the loss. So if you take in, $2 on the trade and it grows to 4, you're out of the trade. So you're really, minimizing your loss. So yeah, we like that strategy. We don't do that necessarily in here. We have tried some SPX strategy, and so that's that great strategy. And Bruce, you said you did the SLB trade, but after the stock dropped, will you post an update on the? Yes, I will. So when I post it in the group, and that is a dividend, that's a bond substitute trade. So luckily we had about 30% of downside protection. So the goal there is we want to get the, sell far enough out, deepen the money to get that downside protection, and collect both dividends. So that's, but yeah, I will definitely update you. And if you don't hear something, just reach out and ask for an update. But right now we're not doing anything because our calls are, way, way out of the money. So hope that answered your question. Yep. So anyway, hope this has been helpful. Our website is here, and we have an email, conservativecalls@gmail. So if you have any questions or just want more information, we'd love to talk to you. And we're going to be planning another 4-week training session coming up soon. So if you'd like to kind of spend 4 weeks kind of learning all of these different strategies, we'd love to share them with you. So anyway, I hope this has been helpful. It's been a pleasure, and I really appreciate you guys jumping on a call after a long day. It's good to see so many people here. And anyway, I'm going to stop the recording here.